Hello, welcome to the replay. Thanks for joining me on tonight's live, which is all about how to prepare for a stock market crash. Very important, I think. It's a bit like what would you do? Hello, Simon. Nice to meet you. It's a bit like what would you do? The whole concept of this preparing for a stock market crash is not to try and forecast the future or try and be market timers or Mr. Clever or Mrs. Clever. But it's just about going through lifeboat drills, as we call it. It's the same as what would you do if a big wave hits you? Not if, when a big wave hits you. What do you do? So rather than wait for these issues to happen, what we have to do is we have to know all about being prepared before the event. And going through it in your mind, preparing for a stock market crash is a very important part of building wealth. So very, very important. So that's what I want to talk about tonight. Don't know about you, it's very, very warm here in sunny Suffolk. It's probably sweltering wherever you are. If you're in the UK, if you're abroad and you're further down the equator, it's probably even hotter. So very hot day today. Don't know about you, I've been working in a garden under a tree, went for a walk, been to the gym, had a shower. So I feel sort of half normal now. So thanks for hanging out with me tonight. Been very warm, isn't it? Very, very warm. So I wonder how you're all feeling. Hi, Tamsin, good to see you. How you're feeling on the first or the second day of Freedom Day if you're in England, or Loosening Up Day if you're in Wales or Scotland or Northern Ireland. I don't know about you. I haven't really noticed any difference. In fact, I haven't really changed anything I'm doing. The only difference that I'm doing at the moment is when I arrive at my gym, I don't do this facade of putting a mask on to walk along the corridor, to go up to the gym, to take the mask off, to then have a workout. I just walk straight in. Obviously, I don't give people French kisses or bear hugs, but I just walk straight in and that's it. So it'd be interesting to see what happens to the economy, wouldn't it? Who knows? And it could well be the straw that breaks the camel's back, because if there are all these supply problems, labour problems, a resurgence of the virus, I don't know. You only need one thing, and in hindsight it seems obvious, but at the time you don't know. But sometimes when markets are quite high, it only needs one or two things to prick the bubble. So tonight we're talking all about preparing for a stock market crash. So I'm just going to not hit a market forecast, but just to take you through some basic stuff so that you are prepared when it happens. What's that? Oh, well done, Tams. You've been setting up a paddling pool for the 16, 17-year-olds. Well, do you know what? You're never too old to have a paddling pool, right? Never too old. We had a paddling pool originally when the kids were younger, right at the top here of the garden at the back here by the conservatory. It was one of those massive, great big ones, about, sort of 2-3 foot deep. And it took forever, like a day to fill up. And it was all great until I think I tried to get in once and I sort of pushed the side down a bit and I don't know, water came out and it was a catastrophe. But it needed lots of chemicals and stuff like that, so we don't get involved in that anymore. Plus they're a lot bigger, but there we go. Okay, good, paddling pool, love to hear it. Right, so what do we mean about, let's just talk about stock markets for a minute. And I'm not talking here about property markets. That's something separate, but the same principles apply, but in a slightly different way. I just want to talk about investments that go up and down, you see a daily price. That's what I'm talking about, okay? So, and I think if we demystify this, if we look at what's the worst that can happen and we go in with our eyes open, then we make a good decision. And as I say, I'm not here to supplant the taking professional advice, whether that's online or a traditional face-to-face advisor from a regulated financial advisor or advice firm who can help guide you and help you make personal decisions that are right for you. I'm just trying to give you some bit more equipment, ammunition, if you will, so that you can be mentally ready for this. Because investing is all about being not trying to blow the lights out. It's trying to get a fair return and stay the course, and that's what this little half hour is all about. So if you've got any comments or suggestions or ideas or thoughts, just chuck them in there. Just chuck them in the comments. Very happy to. I see. The truth is coming out now. Tamsin's been in it. Yeah, but have you had your Tamsin? Have you had your armbands on? Because I don't want anything to happen to the foremost divorce financial planner in the north. Very important. We've got to look out for our resources there. All right, so let's just talk about a couple of things here now. Risk and reward related. If you have higher risk, okay, then you should expect higher return. Or if you have higher return expectations, you should expect higher risk. It doesn't always happen with different investments. Sometimes we take massive risks for very low return, and other times we get very high returns with actually a lot lower risk than we thought. But as a general rule, risk and return are related. So right? So higher return investments come with higher risk. So if you see something that says 10%, 12% return and it's on the internet somewhere, what that really means is you're going to take some serious risk of your money, a risk of either completely losing your money, which is possible, or that the returns aren't going to be as you expected them to be. Now with stock market investments, if you're investing, in a global equity index fund, which is, what I recommend generally as the default position, unless you can find someone really smart to make better decisions for you, or you're really smart and you can pick shares in different individual companies, then basically speaking, what will happen is the chance of you having a complete loss of your money in a global equity fund is near to impossible as it's possible to have. I'm not saying it isn't possible, but it's very unlikely that you would lose all of your money in a globally diversified equity index fund. It would mean that every company in the world would have to have no value and have no ongoing future. It's possible, but unlikely. But what will happen is the day-to-day value of your shares, so that the global equity index fund, will go up and down according to supply and demand. And that supply and demand is on the whole driven by sometimes fundamentals, that people have got money and they invest rationally for the long term and they want to participate in profits. But a lot of the time it's irrational, it's based on emotion, it's based on fear. And I've got a good book recommendation for you in a bit if you stick around. So supply and demand, the best way to explain this is that every day the market comes to you and says, we will buy your investments off you for this amount, okay? And that will go up and down according to, supply and demand. Simple as that. Now, just because the market offers you a price for your investments doesn't mean you should accept it or do anything about it. So, giving the best example is a story I heard from someone recently, all about if you bought yourself a nice car. Let's just say you pay 5,000 quid for this nice car, very perfectly reasonable, very reliable, you're very happy with it. Within a week of buying the car, you get email from webuyanycar.com and they say, we want to buy your car, you paid 5,000 for it, we want to pay 3,700. You think, okay, so it's lost 1,300 quid, but you still want the car, right? You've only had it a week and you still need to get to work. Next week they come and say, we'll give you 3,900. So, okay, so it's worth a bit more this week. Perhaps I should sell it now because it's gone back up. But you still need the car, right? And then the next week they're coming off you 2.5 grand. So did you get what I'm saying? Is that if you're, and this comes down to, I'll give you the factors in a minute, but if you need something for the long term and you're very perfectly happy to own it forever, then today's price shouldn't really be a big consideration for you. But it's not quite as simple as that, and I'll explain why. So here's a little rule, just remember this. When the price of something goes up, the expected return goes down. That doesn't mean there is no return or negative return, but it means the expected return goes down. When prices go down, the expected return goes up. So price and expected return are inverse. So just remember that. Same as houses, when the price of something goes up, whether it's a historic high or it's just gone up, the future return on something will be going down. That's because you're paying more for something, right? Doesn't necessarily mean it's bad. I'm not saying it's something you should be thinking, but just remember, if there was a sale on, let's just say you want a pair of trainers, right? I am actually in the market for a pair of trainers, believe it or not. Actually, sorry, that's my dog Jet, he's a bit mad. If I do want a pair of trainers, and obviously everyone likes to sell, so when the price goes down, more people go and buy trainers, and I would be more encouraged to part with my hard-earned money to buy a pair. But when the stock market has a sell, which means prices go down, everyone retreats, or a lot of people retreat because they get frightened. But when the price goes up, everyone wants to buy it. It's the same with Bitcoin, crypto, etc. When the price of something goes up in investments, people want to pay more, they all want to buy it. But when the price goes down, they want to buy less. So that doesn't make sense, does it? Let's just have a look at this comment here. If you lose all your money in a global equity index fund, the world has a lot more problems than you lose in your investment. Yeah, that's absolutely right. As I say, we've got other problems. Now, I'm not saying we haven't got global problems, but what I mean is absolutely there are bigger problems. You're probably going to need as much cat food as you can possibly store and eat, and some double-barreled shotgun. Probably. That's probably what the situation is. So, price goes up, expected return goes down. Price goes up, expected return goes down. So, there we go. So interesting, that's a real simple little thing. Now, stock markets as a general rule, and please, if you're an anorak and you've got the returns yearbook from JP Morgan or someone, please don't write in and tell me I've got this wrong, but roughly a third of the time they are growing, a third of the time they are falling, and a third of the time they are recovering, right? So we've got growing, falling, recovering, growing, falling, recovering. Now, That's broadly it. Now, what we don't know is when they're going to fall, when they're going to recover, when they're going to grow. But as a rough rule of thumb, you should expect a stock market crash on average around about every 8 to 10 years. Now, there's lots of different definitions of what a crash is, but a crash is, or a correction is probably 10%, a crash is anywhere between 30 to 70%. 1973, the stock market between 73 to 74, from memory, dropped over a 2-year period, it dropped nearly 70%, roughly. The UK stock market and global stock markets were similar. So that's the sort of thing, it comes with the territory. Volatility, which is this going up and down and this horrible ride like the roller coaster, is the price that you pay for getting additional returns. That's it, right? So volatility, as opposed to total loss, is the price we have to pay if we're buying a global equity index funds. Now, just a quick shout out, if you haven't already seen it on Jason Butler Financial Wellbeing, the YouTube channel, I've got several videos on there in the playlist, but the latest one is all about global equity index funds and explains it to you. And I've also got one about the difference between speculating, investing, and saving. And I've got one in there about the basics of investing, okay? So you might want to check those out. So rough rule of thumb, we are growing a third of the time, we are falling a third of the time, we're recovering. So that's volatility. Volatility is the price we pay to get access to the global equity index fund or any kind of equity index, right? So let's just have a look here. Yeah, so how do you feel about seeing, let's just look at your pension. Let's think about your pension. Everyone should have some form of pension pot. I'm not saying you don't have lifetime ISAs, I'm not saying you haven't got any investments, but most people have got some form of pension, a workplace pension or a self-employed pension, something, even if it's only worth a few £100. Most people will have a fair allocation to equities in their pension pot, right? Whether it's a global, whether it's a company scheme, whether it's your own scheme or self-employed scheme. So you just got to say to yourself is, should I be worried when stock markets crash? And the crash is somewhere between 30 to 70%. Well, we'll come back to that. It depends, right? It depends on a whole host of things, but primarily it depends on your time horizon. When am I going to need the money? If you're 23 and this is when you're 60, who cares? The amount that's at stake, how much are you investing? Is it new money? Or is it money that's already there? And the frequency of which you're investing. So if you're doing amounts monthly, who cares? If you're still adding, you've got a long time horizon and you're investing monthly, 50, 100, 200 quid a month, why are you worried? I'm still investing every month, right? Because although I don't necessarily need to keep saving money, I'm earning money, so I still keep investing, still keep saving, still keep building up money. So I'm less worried about that future money than I am the money that I built up. But obviously I'm different age to you, so I've got different circumstances, but I'll share that with you in a minute. And it depends whether you're in the accumulation stage of your life, still building wealth, or whether you're in decumulation. So I'm in a no man's land. I'm not really accumulating, although I do tend to because I earn more than I spend. And I'm not decumulating because I'm not living off my money. I'm not really drawing on my money. So I'm in that funny world. But for most people who are probably listening, you're probably going to be still in the accumulation phase. If you're quite young, if you're under the age of 40, 45, if you're saving monthly, then it's probably not a big problem. And that's the audience and that's the message I want to get across tonight. For most people who are saving in for their pension pot or their longer term, actually when we get the next stock market crash, and it's when not if, because it happens, as I said, every 8 to 10 years, what you want to do is you want to punch the air, right? You want to do a little jig. You want to get excited, right? You want to you want to get excited because do you know why? Next month, you get more units for your money. Next month, it's a sale. And if that carries on for 2 or 3 years, you're getting more and more units. And then when the world turns, your investments go up. So the thing about stock market crashes is it really much depends on where you are. Now, if you are someone who's just approaching having to live off your pension pot, and that's all you've got, or that's the main thing you're relying on, and you're a way away from getting the state pension, which is at the moment 66, going to 67, going to be 68, probably be 70 in due course, then you need to be a little bit more careful. Because if you're going to start drawing money off of your investment pot, and that coincides with a 2 or 3 year period when the investment returns, the stock market's fallen and it stays low, then what happens is you exacerbate those losses. Now listen to me carefully what I'm going to say. This is really important for anyone approaching, just coming up to or within a year or so or two of starting to draw their money off. You can call it pensions, you can call it retirement, I call it financial independence. if you know anyone or it affects you and you're approaching that period when you have to start drawing money off, then you may want to take advice from a financial advisor about, do you need to reposition your portfolio? Because whilst markets at the moment are at historical highs, and yesterday we had a little bit of easing back, couple of percent, today it's come back 1%, but it just shows you what's possible. If you are approaching either needing that money for a capital item, like to buy a house, or to draw on it to meet your retirement needs, and in retirement, or when you're drawing your money and living off it, the first 10 years of you drawing that money off of is the most critical. So if your first 5 to 10 years of your retirement coincides with a stock market crash and very low returns thereafter, then you can increase the chance of you running out of money. Okay, so that's what we call the decumulation stage. So let's just go back over that. If you're young, you're investing monthly, it's in some kind of retirement pot, pension plan, or something for the very long term that you're not going to need, then you probably don't have to worry when the next stock market crash comes along. You can rejoice because every month thereafter you're getting more units or more shares for every pound that you invest. If you're older and you're getting nearer to and you're not far off needing to take that money to buy a house or to draw on, to live on, then you need to be careful and probably take advice. Do you need to perhaps reduce the amount of risky assets, equities or bonds or whatever, and reduce that and then gradually, so make it more defensive and then gradually ease it back into the market over time. Now that is where you really can get real value from taking financial advice from a regulated financial advisor, particularly one that works in what we call the at-retirement market, the decumulation market, because stock market crashes in the first 5 to 10 years of you drawing money directly from your pot, okay, income drawdown we call it, that's super, super critical. You get that wrong, you may never recover, or you may run out of money, or you may not just have enough to meet your needs. And that's why taking advice at critical times in their advice, personalised advice from superb experts who've got proper modelling software, who've got the qualifications and experience, and who can help you work out, the difference between your required lifestyle costs, your desired and your aspired. So if you gradient your needs, your spending needs, when you're approaching retirement and a stock market crash happens, then you just drop the aspired goals, go back, the desired goals sort of trimmed back a bit, and then you just focus on the essentials and the required. That's what a good financial advisor does. Let's just have a look at a little comment here. What's this? So Lukey Lou, I've started to invest to buy a property and we need it in 5 years. I put half in cash and have half in a global index fund. Should I put the rest in? Look, here's the thing. I can't give you investment advice, Louis Lou. What I can say to you is that I wouldn't be putting the other half. I'm a bit concerned about you having half in global equities anyway for a house you're going to buy in 5 years' time. Because let's say the stock market halves next year, this year, 50%. That's not uncommon, right? Particularly where we are, exceedingly high market valuations. I'm not making any predictions. Let's just say you've got 20 grand. You've got 10 grand in global equities, 10 grand in cash. Suddenly, what happens? Stock market will crash 50% and it doesn't bounce back, right? Because there's some structural issue that money suddenly gets more expensive. Interest rates start going up. There's a structural change in jobs market. Some new robot system comes out. Suddenly, your 10,000, that's half of your 20 grand, your 10,000 is now worth 5. I mean, how long is it going to take you to build that money up? So I would suggest to you that I wouldn't put the other half on if it were me and I've got a 5-year horizon, because 5-year time horizon is not enough, okay? Because stock markets can take many years. So where we are right now with valuations, sorry about that, that's my dog getting mad. Yeah, stop it. Sorry about that. Where we are now is the expected return from equities is about 0. That's the expected return from equities where we are now. So if you were to add more money to it, not only have you got a lower expected investment return, but going forward, but you've got a higher chance of it falling in value. So remember, when prices go up, expected return goes down, the probability of a crash goes up. So I'm not predicting anything. I'm just saying you cannot afford to invest your money for that kind of thing when you need to be thinking 10 to 15 years. Peter got a good question here. So what do I think of the FIRE guys that don't advise saving for a pension? I don't know what they're talking about. I don't quite understand the issue there. The FIRE movement is financial independence, retire early. How you choose to build your wealth And when you draw on it, it's up to you. Why wouldn't you use a pension pot for part of it? And I said, and I've written about this before, a pension pot's just one form of saving. And if you look at the latest, I've got a new video coming out, it came out last week on pensions, which is a kind of overview on the YouTube channel, Jason Butler Financial Wellbeing. And I explained to you the basics of pensions and the pension pot, and they're government sanctioned, but I've said it's not the only way of building wealth, right? It's not the only way. You could be using property investing, you could be building a business, you can be investing in lifetime ISAs, you can be doing all sorts of stuff. There's no one way to build the money. So, for instance, I would be mad not to use a pension pot for me for part of my wealth because it's not on my estate for inheritance tax. It grows tax-free. I don't have to pay any income on it until I choose to draw on it. So there's lots of pros and cons for this. I've not seen anything where they're saying anti a pension pot. A pension pot is just a tax wrapper. And for me, I'm not going to get into a big thing about use of tax wrappers. Go and check that video out and see what I say. I'm here really talking about the investment solution, which is when you are investing in global equities, they will suffer a crash every 8 to 10 years. Sometimes it's modest, sometimes it's a blip, sometimes it's more significant. But when prices are high, expected returns are going to be lower. And that's the point. So in answer to your question, Peter, I'm agnostic about the tax wrapper if it makes sense. So yes, I don't use pensions exclusively to hold my investments because I wouldn't, obviously we use ISAs and all sorts of stuff like that. Some super wealthy people use offshore bonds, offshore trusts and foundations, family investment companies, lots of different wrappers. Let's not get hung up on the wrapper. I'm today only talking about the drawing of the money when it comes to when you've got exposure to global equities, okay? So, as we said, time horizons are really important. If it's less than 10 years, I'd be very wary, and that includes if you are approaching retirement or living off your money. So let's give a sock to the fire, guys. When you're at the stage of having to live off your money, anyone who's starting to live off their money or approaching that time needs to be approaching the current market situation with a great deal of caution. If you're thinking of buying a house in 2, 3, 4 years' time, I'd be very concerned about you putting more into the market, and I'd be feeling more comfortable you gradually drawing money out because the expected return is so low. So let's just have a look at a couple of other things then. Are stock markets expensive? Who knows? You can read around this subject till you're blue in the face. I don't know any more than you do. All I know is that there's something called the price-earnings ratio. Okay, and this is basically when a share price, the share price divided by its earnings is basically a multiple. So if a company makes £1 and we pay £20 for it, the price-earnings ratio is 20. It means we are paying 20 times the current amount that company's making. Okay? And don't forget, when companies make money, they don't pay it all out as dividends. Sometimes they reinvest it, sometimes they buy their share back. So basically, when the market pays a big multiple of current income, of current earnings, which at the moment it's about the global equities is somewhere between 25 and 27, roughly, depending on which index you look at, that is historically high. It's traditionally been, typically about 14 to 15. But there are periods, 2000 when we had a stock market crash, 2009, the global credit crash, last March when we had a 30-odd% crash, when that compresses and that goes really low. So when stock market's falling value, that price-earnings ratio drops as well. So the norm it varies depending on which index you look at. It's normally 13 to 15, but it's only one measure. There are lots of other reasons. There could be reasons why the market is being valued at a certain figure. It could be because there's lots of innovation to come, or there's pent-up demand, or lots of more demand to come from new markets. There's lots of reasons why the market may well be pricing things at a certain way. But here's the thing to bear in mind is that the price you see today factors in everything. It's already factoring in. The news is coming out all the time. So you can't really get ahead. You can't really beat the market. The market is merely just telling you what it will buy your investments for today. Now, as I say, if you're young, you've got a long time before you're going to use that money, you're saving regularly, you're not going to touch it, you don't need to worry about so much that. It's the people who are going to be drawing on the money in the near term, next year, 2, 3 years, and all people are going to be living off the money. That's the key. Now, someone asked me, sent me a question, said, Jason, how do you invest your pension fund? So let's not get hung up about tax wrappers, but let's just talk about my regulated pension. Now, pensions are a bit of a difficult thing because there's a limit to what you can hold in them, about 1.7 million, 1,070,000. So So I'm happy to share with you, my sort of investment mix, but don't take this as an investment recommendation. But I'm just trying to give you an idea of where I'm thinking. So my pension pot only is invested 40% in cash, 50% in index-linked gilts, and 10% in global equities. It doesn't mean I've only got 10% in global equities, but it's in my pension pot. And one of the reasons for that is because I don't want my pension pot to grow too quickly because of various tax implications. And also, because I don't need to keep playing that game, I don't need to keep blowing the lights out of it. All I want to do is preserve the purchasing power. So to have sort of 60% of it in equities and index-linked gilts, but the large amount in index-linked gilts, that is my inflation protection. So index-linked gilts won't get me more than inflation, but they just get me basically inflation. So that's why I hold them. So let's have a look here. Now, Lukey Lou, yeah. So, well, in answer to your question, I've got a new video coming out this Friday, Thursday or Friday, called Saving and Investing for Children. So that's on the YouTube channel. I take you through the options for you and how to think about what account to open, what kind of investments to hold, the pros and cons of it all, so that you can make informed decisions. So that's a great answer. But here's the thing, just a little sneak preview. If this is money that you are happy for that child to have when they're 18, if they are, how old are they now? Let's have a look. Under 5. If they're under 5, and if it's money from child benefit or from birthdays and holidays and gifts and stuff like that. Both my girls, I started investing in global equity index funds when they were young. I think Daisy must have been about 4 because we were skint when she was born. We had no money. And Megan from the day she was born. And I've always saved and invested for them, and they now have quite nice, healthy balances. And here's the thing, with both my daughters, I'm not worried for them, and I've told them not to worry. If there's a stock market crash, who cares? That's their capital, that's their get ahead money, and they've got cash and they've got other bits and bobs. So if you're young, if you're saving for a young person, it's a great idea to start early. But do modest amounts. Get used to investing and get used to seeing markets go up and down and hearing all the stuff on the news. It's much better to start off with something you're going to keep doing and you're going to stay with. But yeah, if I had children who were under 5, and as long as I had all my own situation sorted and I was comfortable for them to have the right to the money at 18, then I would be quite comfortable putting modest amounts, at least the child benefit money, into a global equity junior ISA. Or if I was worried about them receiving it at 18, I could put it in my own ISA, unless of course you're ramping out, you've got more than 20 grand a year putting in. And one of the beauties about putting it in your own ISA is it leaves open the options for you to decide whether you want to give it to your kids or not. But you've got to be super disciplined that if there's a stock market crash, you don't suddenly head for the hills. So there we go. So I've shared a few things there. Now here's the thing, will my pension pot, will I change the asset allocation? Bear in mind I'm 52 and I'm still not living off the money yet. If there is a stock market crash, a meaningful one, and I mean sort of 25-30%, I would be tempted to put 3/4 of the cash pot into global equity index. Because remember, price has gone down, expected return's gone up. When price goes up, expected return goes down. I'm not worried about the volatility because I'm not drawing on the money for a bit. But for me, if there's a sale on, a stock market sale, then I'm happy to participate in it. But if I'm not happy to pay a premium for the benefit of owning equities when I've already got enough money there to live off. So everyone is different, but I just want you to take away this. Stock markets fall and they rise and then they make new ground. 1/3 of the time they're falling, 1/3 of the time they're recovering, 1/3 of the time they break new ground. If we believe in capitalism for all its faults and it has the ability to create value, deliver services and make profits, as long as it's sustainable, and I'll come on to that in a minute, then there's no shame in participating in it, is there? But you've got to get a handle on your spending. You've got to be building up savings. You've got to have some wriggle room. You've got to have a plan. And the first thing you've got to have is a plan for your spending. And that's got to be linked to your priorities and your values. So hopefully that's been of use to you. We're coming up to, let's have a look, if I missed, make sure I haven't missed anyone, anyone's questions here. Just make sure I haven't missed anyone. Good stuff, let's have a look. Good to see you, Peter, yeah. So basically, stock market crashes happen. right? It's just what you have to pay. But that's not the same as a total loss of capital, which is what you can have with things like crypto or your mate's new business he's going to start that's going to change the planet. One thing I would suggest you look at, though, is ESG investing, which is environmental, social and governance investing, is going to become dominant. But just be very careful that you're not getting sucked into some sort of thematic idea or someone greenwashing, someone giving you a story. And be very, very careful about investing in startup businesses through things like Seeders and Crowdcube that sound great. Oh, and I just put 400 in. Look, I've never seen a business plan that says we're going to fail. Most of those businesses you're going to back are going to fail. Don't get sucked into the story. Look at it from a cold hard light of day. Learn to invest in a global equity index fund. Learn to stay the course. Understand the peaks and the troughs. And learn that first before you do anything else. And remember, when you start bragging to your friends about how much you've invested in global equity index funds over the last year, as opposed to how much you've spent on a car or how much you've done over here on something else, or the swanky holiday and the pictures, once you do that, then you've made a paradigm shift, okay? I love accumulating investments. They're like great fun. They're like friends of mine, all right? They are difficult sometimes, and sometimes you fall out with them, and sometimes you don't want to be around them, but most of the time they're there, right? A bit like family, really. So from my point of view, is you've got to learn to live with investments, and but don't back the horse on it all. So let's have a quick look here before we go. Where's the best place to watch the market daily, please? Well, here's the thing, Happy Light. I would suggest that you don't watch the market daily. I think you should watch your bank account balance daily. That's what you should be focusing on, where you're spending your money every day. But look, stock markets you can't control, right? So yes, it's nice to be of interest, but just don't. You can put an app on your phone, but what's it going to do? It's just going to make you upset when you see it going red. What you need to do is check in on your net worth, which is everything you own minus everything you owe. Check in on that once a month. Track that. Talk to your partner about it. That's what you'll be focusing on, because when you're young, the amount that you can add to your pot, whether it's your savings pot, your investment pot, your long-term pot, whatever it is, that's always going to be probably more than stock markets can either give you or take away from you. So your ability to control your spending and your saving rate is the thing when you're younger that you can control. But please try not to look at daily stock market prices. As I say, it's a bit like the person you bought a car and someone keeps knocking on your door every day, keeps telling you, I want to buy your car for this, I can buy your car for that, we can buy your car for that. Well, it doesn't matter because I want to keep my car, thank you. So try and avoid the noise. I did say I was going to give you a book recommendation before we finish. Crazy Money. This is written by a great lady called Maggie Baker. She is a financial psychologist, right? And she has spent 30 years interviewing all sorts of crazy people like me and you, right? Because we're human. Humans aren't wired to be normal with money, right? We are emotional. And it's a great book. It's, if I'm really honest, it's quite a bit of a heavy read. But if you really like this sort of stuff, that's a great book to really understand yourself more. Lots of examples of people she's worked with, their money stories and stuff like that. I use it for research. It's a good book from someone who really has practice with people. So there we go. Investing is an emotional thing, but we need to do it for logic. But thanks everyone for being here today. Great to see you all. Share the love, tell everyone else, and I'll see you again next time. See you everyone.